Hello and welcome back to my channel. Today we're going to be talking about a quick guide on short selling and the short selling basics. I think this is important to understand both if you're going to try short selling and also if you just want to do regular stock analysis to understand if something's going on in the shorting market, just what it means and how you can use it towards your advantage. So let's go ahead and dive right in and get into the no syrup or no sugar coating approach to the basics of short selling. So one of the reasons I decided to make this video was because something in the news that's has a lot to do with short selling has to do with Tesla, and it's obviously a company that you may or may not have heard of, but very popular and for their selling of electric vehicles and more of like the environmentally friendly approach. But one of the reasons that they've been in the news is for they have a lot of famous or in the news short sellers against their company, betting that the company will go down in price so that they can make money. And Tesla recently has been rallying like crazy, which I can show you stock price here, which is not good for short sellers, obviously, because if you're betting that the price is going down to make money and it goes way up, you're going to be losing money. And so I'll get into in this video how that works and how you lose money, how you make money, stuff like that. But obviously they've been in the news because, as you can see, this is a large movement upwards in their stock price that was a little bit unexpected, and for some of the short sellers, obviously. And as you can see here on finviz.com is what I'm on right now, the perfect half year, you would have made 103.45%, which is quite a huge move and very, very bad if you were a short seller. So, like I said, they've been in the news, and so let me just break down what exactly short selling is, how it works, and stuff like that, how you can use it to your advantage. So, I have some notes here on the side of the screen, and just going into what exactly short selling is. So, the basics of it is you're trying to make money from a security or an equity, something that you invest in going down. That's what you hope for it to happen. This is the exact opposite of say something like a long position where you hope that the price will go up. This is the exact opposite. You are betting that the price of whatever you're investing in is going to go down. So that's the basics, fundamentals of it. Exactly how this happens is you are, from a very basic level, what's happening when you try to make a short transaction. You are borrowing shares from your broker and immediately selling them. So they get the shares and they let you borrow them, and then you go ahead and sell them in the market immediately at whatever the price is, because obviously you're hoping that it goes down. So you collect that money from that original sale, and then this holding period, which is essentially the time that you're waiting for your thesis or your hypothesis to play out, so that you hopefully make money. And that's the in-between period. And then when you want to close out the transaction, you repurchase those shares, hopefully at a lower price, and you return those shares back to your broker. So what you're trying to do is you're trying to sell them at a high price, collect that money, and then wait for the price to go down, and then repurchase those shares at a lower price, and hopefully to pocket the difference. Obviously, there's a lot more that goes into it and a lot more cost and stuff, because as you can imagine, you're borrowing shares, so you're going to have to pay for that right to borrow them. So there is going to be some cost that goes into it, but we'll get into that. So some of the risks that I pulled up here this is coming from visualcapitalist.com, and it's talking about, is short selling stocks worth it? Basically because the highest you can make, obviously, when betting that something's going to go down, I'll give the example of Tesla here. The highest you can possibly make is, if it goes to zero, theoretically, would be 100%. So basically, you would be betting that the company would be going non-existent. So that's one thing to understand, is that your upside return is capped versus something, say, like a long position where you have unlimited upside potential and capped downside potential, because you can only lose what you invested. So that's one thing to note when going into this, is that you do have cap side up potential, because you can't go past 100%, because you can't go anything. It goes to zero. That's the most you can make. And so that's one thing to understand when doing this, is that you are capped on your returns. So they kind of go in here, show this infographic here, and go into talking about what I was talking about with the steps that go into how to short sell and what exactly you're doing. Here they're talking about you got to identify the stock, then you have to open your margin account, because a margin account allows you to borrow from a broker, and then you sell the shares in the market like I was talking about. And then step 4, you wait for the stock price to fall, or the holding period that I was talking about. And then when you want to close out the position, you buy back the shares at the lower price and return the shares to the lender or your broker, and then hopefully make profits on it. This goes without saying that your upside potential on the price of the stock going down is capped. So that means that if the stock goes against you or goes upward, like this Tesla stock that I was talking about, you have uncapped risk potential. So you can literally keep going up and up and up, and you can keep losing more and more and more money. So that's one thing to understand, is that you have unlimited downside risk and capped upside risk, which is one of the things why some people just don't do short selling at all. And so here in this infographic, they get into kind of the risks of short selling. And so you have like the stock borrowing costs. There's some brokers may have some other payments that you have to purchase. There's dividends. So if the stock that you're shorting pays a dividend and you go past the next dividend date, that comes out of your pocket to pay to the person that you're borrowing the shares from, because they are technically holding the shares. So you have to pay that to them. So that's another cost that goes into it. And then also margin interest, because you are borrowing them. So you're paying for that cost of borrowing. And one last thing I'll get into is a short squeeze, which is why Tesla has been in the news, because there's been some large traders that have bet a lot of money on that Tesla will go down. And obviously, since Tesla has been skyrocketing, some are saying that it may or may not be a short squeeze, which a short squeeze is basically what happens, like I was talking about, at the end of your transaction, you have to buy back the shares to close out your position. So what can happen if a trader is getting nervous because the price keeps going up and up and up, if they want to close out their position because they're worried that their thesis or their hypothesis may be wrong, obviously that adds to the buying pressure. So basically upward buying pressure, pushing the stock higher, because they have to repurchase those shares. So that means there's more people in the market purchasing, basically pushing the price up. So that's what a short squeeze is when you have a stock with, here's the short float, which is the amount, the percentage of the shares outstanding that are being shorted. And so with Tesla, it's 19.30%, which is pretty high. And so what you'll have with stocks with a high short float is that if a large portion of these people that are shorting it decide that they're worried that it keeps going up and they want to get out of their position, they have to buy back those shares. And so if a large portion of this float repurchases or closes out their short position at one time, it can push the price upward, creating more upside risk for short sellers. And so because every time this goes up, they're losing more and more and more money. So one of the things to understand when looking into short selling is that there is the effect of short squeezes, especially on something with a high short, a stock that's highly shorted, and has the potential for people to liquidate those shorts or to get out of those transactions, and which can push the stock price upward, which only adds to, if the stock's already going up and then you have more people purchasing the shares as well, that pushes the price even higher, which is a self-fulfilling prophecy that just keeps pushing the price higher and adding more risk onto the plate of short sellers. So one of the things I wanted to show, this is coming from marketwatch.com, which is an article of oil stocks that were exhibiting a short squeeze, and so it was basically showing that this is like a practical example. because Tesla, with the large short sellers or people that that are large portfolio managers that manage a lot of money, sometimes they won't be phased as much with the upward price movement because they're more professional traders and they have a larger hold or a long-term time horizon with which they're waiting for their investment to play out. But some people, if their short selling base of people is not those big professional hedge fund portfolio managers that get emotional and want to get out very quickly. You can see this happening in some other ones, especially where retail traders are involved and where retail traders are trying to short something. Generally, with the lack of experience, can add to the possibility of a short squeeze. So as you can see here with this short squeeze in, it looks like oil, there was that very quick upward price movement, and especially with it being a very low price, as you can see, a $2 or less than $2 stock, basically just only adds to it a little bit more with if you have buying pressure plus people trying to get out of short positions, pushing that price way up, and so adding to that level of risk to understand when you are short selling. So that's basically everything that I had for this video. Leave down in the comment section any extra things you'd like to learn about, any things that I may have missed in this video that I can cover in a later video, and I can get to those and make a whole nother video about it. But just wanted to go over the basics of short selling and how it can be applied to you. Even if you're not a short seller, it's good to understand if you're investing in something like Tesla that may have a high short float stock, and what that means for your investment, especially if you're going long or betting that the price will go up, what exactly that high short float can mean when you're investing. So go ahead and give this video a like and subscribe for more, and I'll see you guys in the next video.